in all seriousness, there are ways that you can put money in and have significant gains over time without risking your original principles.
Welcome into the Safeguard Podcast. I am Outnumbered.
Matt, can we please change the subject?
At Safeguard, we want to be versatile. We want to help in every way that we can and not just in one certain area or one certain product. We want to be holistic planners for you. A good agent or advisor should provide you good information regardless of whether they sell you something.
It is so frustrating that people are penalized for making a mistake when the government doesn't do anything to educate them.
Honestly, shouldn't it just be about helping people? Listen to this. 33% of men and 43% of women have no life insurance at all. That doesn't even count the people that don't have enough.
Insurance has the power to change people's lives.
You have got to be sure that you educate yourself before you make major decisions. Honestly, I couldn't imagine not being a Safeguard at this point.
Hey everybody, welcome back into Outnumbered the podcast. I'm excited. I am Matt.
And I'm Stephanie.
And we're back. And we're just pumped up to be coming at you again this week.
Yeah, I'm very excited.
So last week we talked about budgeting and debt. See,
no, it's
okay.
Debt.
See,
yeah.
Whoopsies. But anyway, we talked about debt last week. We talked about budgeting the week before, and so anyway, it all gets switched around in my head. So anyway, it's all good. So we talked about debt and trying to climb out of it and what to do and what if you have a mountain of debt and all that stuff. And so we kind of covered a lot of the financial basics. But now it's kind of getting into, okay, what do we do with all this information and how does this apply to actually doing something?
Right.
And reacting and trying to make plans and stuff like that. And so we want to start getting into that. And really, a lot of times we have a Safeguard scoop or whatever, but honestly, the scoop is really what we're talking about today. And what we want to talk about, it's very pertinent during this time, really this year, is the recession and market volatility and things going up and down in your investments. And so
I guess we should probably say impending recession.
Right, okay, so it's not technically a recession yet. It's really if it's 2 quarters in a row. But we're about 4 or 5 months into a pretty conclusive recession. And so it might correct here within a couple of months. If it does, then it wouldn't technically be a recession. But it hasn't been like 2020 where everybody got scared and then realized that it was probably fine and the market immediately corrected. This is something that's been prolonged and it really looks like potentially it could get worse. And so all the prognosticators, everybody says that it could get much worse. Some people say that it's going to be fine, but a lot of those people probably are in the minority. Yeah. It seems like things might be getting worse. And so what do you do? It's scary, especially if you're looking at, what if I'm about to make a move financially, or what if I'm about to retire, or I'm getting older, or I'm already retired and on fixed income.
Yeah, and I've got to make this income last the rest of my life.
Right, and so it's really concerning, and so we want to directly address this issue today, and talk about what we see and the concerns that we have, as well as what could we possibly do to try to rectify this over time, and really talk about what to do in general, because it does matter more possibly that there could be even more of a drop, and 2 or 3% a day is absolutely alarming, which has happened a few times the last few weeks.
Yeah.
And it's down about 20%. You say
22% on the year.
Okay, right. So 22%, nearly a quarter of whatever you have on average, has gone down.
And that is the S&P 500. Now the NASDAQ is actually in worse shape. It is down nearly 32%. It is more of a tech heavy, and it has been affected even greater. So nearly a third of portfolios within the NASDAQ have been negatively affected. by this, market volatility that we're experiencing right now.
Yeah, wow, so 32%. So that is basically a third.
Yeah.
And so you might be listening to us and you're like, you might really be worried about this. You also may be like, what does the market have to do with me? Who cares? What does that matter? I'm not obsessed with stocks, and I'm not going to invest in the S&P 4,000 or whatever you just said. It's the S&P 500, but whatever. You know what I'm saying? And so you're just like, what does this matter? Well, obviously we see the prices at the pump. You see the prices at food. You see a shortage of workers.
Inflation is
while having a huge
historical high.
Right, and so we could really be heading for something that we haven't seen in a long time. Now, I don't want to sit here and be alarmist and freak out and scare everybody to death, but it's possible that it could become the next depression or certainly big recession.
I've certainly seen economists predicting it could be as bad as or worse than the Great Depression. But
worse?
Worse than.
Wonderful.
Reputable people saying that.
I hadn't been looking for it. But,
I have.
She's always looking for the negative.
No, I've also seen people thinking that it's about to balance out and kind of ride where it's at and not really get any worse, which if it continues where it's at, it would still, within a couple months, equate to a true recession. But if it levels out, then we're not going to get to that dramatic, so honestly, nobody knows. The economists, the people who get paid a lot of money to analyze the data and look at all this and the actuaries and everything that goes into this, they honestly do not know. So all you can do is prepare the best that you can and live with whatever decision you made when you prepared. That's all any of us can do.
Right. Absolutely. And I did want to preface this before we get too far in, that this is not a political discussion. No. I mean, I don't think that really should have anything to do with it. It's really more about facts are facts. This is what is going on. This is what the concerns being raised on both sides or whatever, if you want to put it that way.
Yeah.
Everybody's concerned right now, and everybody's trying to figure out what to do.
Placing blame doesn't fix the problem. Finding a solution to the problem fixes the problem. So it's about assessing where we're at and figuring out a solution to move forward and minimizing the damage that's been done as best as possible.
So deep. And that's been the Safeguard Podcast, Outnumbered.
We'll talk to you next week.
That's TTYO. No, signing off. Like and subscribe. No, but with this situation, say your investment, your retirement, whatever, is down 22% or 32%. Maybe you work at a tech factory and all your stocks are in the factory that's gone down, 30 or 40%.
Could happen.
Whatever. And so what are your options? Okay? And everybody has a different response. Sometimes it's sarcasm, like, I'll go dig a hole, put it in the backyard.
Some people do that too. Some people actually do that.
I'll pull up a floorboard and put it under there.
Wouldn't recommend
put it in
that,
the walls,
actually.
Stuff it in the couch, whatever. That's one response. Is that the best solution? I don't think so.
I don't think that's a good idea.
If you do that out of your retirement, enjoy your 10% penalty and your taxes that you owe on it. But go for it, I guess. But that sounds like a horrible decision.
Cost you more money than it would protect.
Right, after it's gone down, so you lose 20%, and then you lose 10%, and then you lose another 20%.
Whatever your tax rate is, yeah.
Yeah, you just
don't do that, guys.
More than cut your money in half. But hey,
please, friends, don't do that.
Yeah. So another one that's very common is ride it out. Hey, if the market goes down, guess what it's got to do?
It's got to come back up.
Got to go back up.
Ebbs and flows. Up
That's
and down.
right. No big deal. Just let it ride. And, maybe invest in some more stock right now because it's low and it's going to come back up.
Buy low and sell high, yeah.
And
these are some finance concepts that people utilize.
And that makes sense, especially if it stops going down from right here.
Right.
If it goes down to the 30% and you heavily invest right now, well, you just lost 30%
on your investment
what you
immediately.
Yeah. And really, it would actually be almost 40% because now you're at 20% less. Mm-hmm. So really, if you really do all that math, it would be 37.5% that you just lost on your original by doing that particular strategy. If it goes down to half, and so you really want to be cautious about how you do these things. Be thoughtful, and if you decide to ride it out, that's a reasonable response, and it probably will eventually come back as long as you don't need it before then. Right. Another is just pull it out of the market and hold on to it. Put everything in cash. In your
within your 401k
or whatever. Just let it stay even, or go with a fixed rate or whatever. Well, you can do that too. And honestly, if it goes down some more, you'll look like more of a genius than someone who kept it in the market and lost.
Yeah.
For now. But also, inflation's going up anyway, so you do a 0.25% on your cash, or in some portfolios, you just literally leave it in cash and have as absolute zero.
Absolute zeros, yeah.
Golly, well, inflation right now is
8%.
8, okay. 8. I was going to say 5 or 6 to be conservative.
8, historical high, 8%.
Okay, so it's pushing 10%. Mm-hmm. So if you're going to leave it in cash, you're now losing 8%. So again, what the heck am I going to do?
And I would say if you're considering putting your funds into cash to protect from loss, I would just reiterate this point of don't forget once the market starts to come back up
to reinvest,
to reallocate that money, put that money back into your funds, because once the market does pick up, and eventually it's going to pick back up, if you're not investing in the market, then you're losing money again. So I would just like to kind of drive that point home of if you put your funds in cash, make sure you pull them back out when the market starts increasing. And we don't know when that's going to be. The experts don't know when that's going to be. We're all just riding the waves together.
Well, absolutely. And really, any of these choices come with risk. And guess what, though? Even in a good economy and everything, there's still the risk of this exact thing happening. Absolutely. And it just happens to be happening right now that we always talk about being afraid of. Well, now it's happening, so how do you respond to it? And what are the risks if you respond a certain way? So you mentioned reallocating, perfect transition.
Yeah.
That's another way that you can adjust what you're doing. If you're invested in all stocks and bonds, and you're not really in, for example, mutual funds or something, the old reliable stocks more like Walmart and Coca-Cola and whatever, all the ones that everybody says to be in no matter what or whatever, that is another response that you can have, is just kind of get more conservative, minimize your losses, and hopefully you don't lose as much as you would have. And then on the way back up, you'll see some gains back, and it'll just be a little bit more conservative, but you don't lose as much. That's also
less to gain, but less to lose.
Right. Also fairly reasonable response. The next thing you can do is let's double down and let's buy a bunch of stock right now because we're low, and maybe it'll pop right back up and you'll be a billionaire.
Which we kind of touched on a minute ago about you have to be careful because if the market continues to go down, then you're just losing your money. But if you get in at a time that the market's low and then it starts to pick up and you basically get, invested for cheap, and then it increases and you profit from that. My one thing that I would like to say is nobody has ever timed the stock market and won. You might get lucky and hit a right time one time, but you're not going to be able to time the stock market perfect every single time. It doesn't work like that. If it worked like that, stockbrokers would be,
a gazillionaire.
Right. If it were possible
Forrest Gump would say,
to get it right every single time, people would be getting it right every single time. There wouldn't be an occasional time that people get it right. So, that's just something to consider. Is it's very, very hard to know exactly when the stock market is going to go up or down.
Yeah, absolutely. So, again, double down, triple invest, go for it. And again, that's something that could work out. It just really depends. And it also depends, like say it does go down a little more, we know that it historically will almost certainly go up. And go up above what it ever was. And so if you're at 20%, you're 20% down on your original, your principal, well, when it comes back, it'll be like, if you double down and reinvest right now, it'll be like getting a 20% bump for free because it'll be there at some point. And so it's all perspective. The next one, which could really be an option right now or in the future, would be to put it in a safer vehicle. Okay? So everyone knows about the market, everyone knows that you can invest and that it goes up and down and whatever, but it seems like a lot of people don't realize that you do have options that you can get positive interest without risking your principal. And so I think that's something that we want to be sure that people know. Okay? And I know we're 16 minutes in, we might have buried the lead a little bit, but in all seriousness, there are ways that you can put money in and have significant gains over time without risking your original principal. So say you've got $1 million and the stock market continues to go down another 30%. If you put it in a safe vehicle, or you put part of it in a safe vehicle, the amount that you put in that was safe is still going to stay at that $1 million or whatever portion you put in. It's going to stay the same. If it comes up, you're going to get some gains. And so if you look at how the charts would overlap, if you look at the S&P 500 or the NASDAQ or whatever, the NASDAQ and S&P and BlackRock and whatever, they're all going to go up and down and kind of look like a radio wave. Well, with something that's more fixed, you're going to be looking at more of a step effect. So it might stay level here for a little bit, but then you get the bump and it goes up here and then it goes up here and whatever, and it continues to go up. Or
it never goes down.
Right. And the worst case scenario, it stays the same.
Right.
And so that, I think, is something that we really want you to be aware of. There are options. If you want to talk to us about that, reach out to us, because we can come up with strategies. We can talk about your how things look right now and how they stand to project. We're getting a lot more people concerned about their money right now than we have in a while, because guess what? They've got a lot of pain right now because they're looking at their numbers and seeing 20% loss. Well, what if I can give you 20% back like that? Or 15 or 7 or whatever. What if I can give you a portion of it back with no strings attached? Might be something to consider.
I just want to talk for a minute about risk tolerance and how that affects maybe some of these decisions that you might make. So somebody who is very tolerant to loss in the stock market would be one of those people that would be more likely to just continue to ride it out and stick with their strategy, or possibly double down and get more. Whereas somebody who is more conservative in their risk tolerance level might be the ones who are fearful and stressed out and want to pull their money out and possibly put it in cash or something like that because they're scared of losing money. So there are different tolerance levels for losing money, and everybody's is different. Even between spouses, it could be a different tolerance level for how much you're okay with losing. So when you're assessing what exactly your strategy is, you have to assess what is your risk tolerance. How much are you willing to lose? If you open up your account one day and you've lost 50% of your account, is that going to be a big deal in your life, or is that going to be an, oh well, it'll come back up, I'll be fine in the long run? Because if you lose 50% in your account, the stock market has to rebound 100% just to get you back to even. Some people believe, oh, if it's down 50%, it only has to go back up 50% to get me back to square. That's not true. It has to go up 100% to get you back to plumb, back to zero, where where you would be at. So if
to play that number out, just so y'all understand what that means. So, say it does cut in half. So just to have round numbers, $1 million goes down to 500,000. Okay. So you just lost 50%. So 10% of 1 million was what? 10%. So how do you get 10% back of what you originally had onto your 500,000? Okay. So 500,000 needs to go to 600,000. What percentage is 10,000 of 50,000? 20%, not 10%. So you need double the percentage to get back to whatever number. Because your investment cut in half. So just to explain why you would truly need 100% to come back.
Because it is a common misconception that, oh, if the market's down 20%, I only need to gain 20% to get back to what I had. No, you need to gain more than 20% just to get back to where you were.
Right.
And if that's the type of thing that's going to keep you up at night, that's going to bother you, then a product like an annuity might be an option for you. Something that's safe and guaranteed and cannot lose money. That might be something for you. If you're the type of person that has a very, very high risk tolerance, that is just like, oh, 50%, no big deal, I ain't worried about it. If it's not, some people have that mentality. Some people believe that, and that's okay. Everybody is different, and I'm not here to tell anybody that one is right or wrong.
I just thought it was funny how you said that.
Then
I ain't worried about it.
Then riding out the storm, so to speak, might be the right option for you. And like I said, everybody is different. So it's just about finding that sort of sweet spot for you and your portfolio and your goals and what you're trying to accomplish in your life, and sort of structuring it around that idea.
And let me say this too. If you're completely in the market right now, think about, you need that 100% to get back, right? Or if you've lost 20, you really need almost 25 to get back to even. So actually it would be exactly 25 to get back to even. So if you were invested in safe money that just would stay even when the market goes down. Say half of your money was in it, or we can pick another number, or whatever. But half is easy to calculate.
Yeah, that's easy calculation. Right? Yeah.
So again, $1 million, 500,000 is in the fixed bucket that you're not losing, but when the market comes up, you're going to get a percentage.
Right.
So half of your money is cut in half. Okay, so you're now down, and then your other half is the fixed bucket, right? So 500,000 and 500,000 are split. One goes down to 250, one goes down to 500. You've now got $750,000. Okay, number one, if you're invested in the market, you're down to 500,000 instead of 750. So if you need the money now, you've got 3/4 of what you would have had versus having half of it. It's a huge difference. Also, when the market comes back up, let's say that it comes back up 25%. Okay, that means. Or let's say, will be a good round number, 20%, okay? So 20% again on your let's see, What would be the best way to do that? 20% would work. Okay. So you've got your 250,000 that is now 300,000. Your 500,000 also went up, let's say, 10%. Okay. So you've now got 550,000 and you've got 300,000. You now have 850,000.
Right.
Okay.
Right.
And it can build up from there, and as the market comes back, you'll get the growth in your other portions in the market, but you'll also have your safe money that's doing really well too, and you will be much more foolproof against these types of issues.
Much more balanced.
Right.
Which is a great thing to be when you're talking about a portfolio. That's a really good point.
Yeah. So I know I threw a bunch of numbers at you, but think about that. It's a powerful difference to have a depression-like issue. Like 2008 would have been a depression.
Yeah.
If it lasted long enough.
A little bit longer, yeah.
Because it really did cut 40 to 60% depending on where you were. Okay. Mm-hmm. That's massive. Okay. Well, if it does end up being that over time, would it not make sense to invest in something that will be fixed?
Right.
And not lose all that money?
That's good.
Something to think about.
That's good.
So, people think about what other solutions are there to invest. Obviously, people think, let's go mutual funds or bonds or whatever. Number one, those are in the market, so they have risk. And also they may not have the returns you want right now anyway.
It's true.
Real estate, interest rates are way up, and if you're taking out any kind of loan, you're taking out huge interest compared to what it used to be only a few months ago. I know people are getting quoted over 6% as a standard rate right now, and it just increased rates
today. So
yeah, was it 0.75?
0.75, the highest historical hike since 1994.
Okay.
So they're basically raising interest rates, making it harder to borrow money at this.
Also,
moment.
real estate is not that available right now in general.
Right.
So good luck finding it and finding it at a reasonable price.
Right.
But again, sure, you can invest in those types of things.
Mm-hmm.
Some things that you may not think about, and sometimes people scoff at this, but I believe it, especially right now, is the perfect time to talk about it. Life insurance.
Right.
Okay. Putting it in something that if you have the cash, you can overinvest in it, build up the interest on it, and then possibly number one, you've got life insurance the whole time. So if something happens to you, your family has assets to take care of the loss of you or the loss of your ability to function. You may be living and still be able to get benefits from that.
Right.
But also, if you make it to that moment that things are okay and you have some cash value that you've built up in this life insurance investment, it could be another retirement vehicle, or you could use it to buy that real estate that you really wanted to, with a lump sum that is tax advantaged or tax free.
Right.
And so life insurance can be a huge piece to a financial picture, especially in times that you're looking to invest something and the market's going down. So if that's you, let's talk, because there are plenty of options in that area for you to shore up some of your other concerns right now versus trying to invest in the market and then lose some more when you put it in. So
yeah, and since you mentioned it, I think next week's episode I want to talk about and dive into taxes. Specifically, want to look at taxes in retirement, but also as a byproduct, we'll be talking about taxes in general for people who aren't necessarily at retirement age, and how changes in tax law and stuff like that might be on the horizon and how that might affect everybody.
That's great. That's a great idea. That's good.
Yeah, I think that would be a good kind of complimentary lesson to kind of go over too.
Yeah. And so the other way to invest is like we've been talking about in safe money. And I just want to encourage you, there are ways to do it. And try to Google if you want, but I would encourage you. whoever you work with, if you already work with somebody, continue working with them, but ask about safe money investing. Is there a way that I can put money in somewhere, guarantee my principal, and get more than 1 or 2%? Because there's absolutely a way to do that. And so I want to encourage you, seek that out, or seek us out, because I believe that we can really help you out.
Right.
So we just wanted to attack this head on, a PSA, whatever you want to say, to look out for you right now in this moment in history where we're concerned. People are losing money in their investments, and we've got to try to put a stop to it or stop the bleeding, because it could really wreck a lot of people's futures. Well, don't let your future be wrecked because you just sit there and watch it. Let's do something about it.
Right.
Let's reanalyze. If you get a quote from somebody and you don't like it, keep looking. Don't just settle for whatever one person ever says.
That's
Question.
correct.
Ask questions.
Yes, absolutely.
What are you gonna say?
I think that's all I really had.
Okay, I heard was that like the 30-minute, like, oh, we're getting
much.
We're getting up there. Anyway, so hey, we're here for you, okay, guys? We're all a team. We're all working together. We're here to help you. There are plenty of agents and advisors out there to help you. You just gotta keep looking. If you haven't found one yet, you found us, and we're here to help and do our best for you. And we'll do everything we can to be there and make a difference for you and your family.
Absolutely.
So, that being said, like, subscribe, follow, hashtag Twitterize, TikTok. We're not on TikTok, but whatever. All the cool kids and their social media and whatnot. Let's follow them. Did I say that wrong? Anyway, give us a follow, give us a like, give us a review, whatever. Come in and see us at 270-904-6070. We love you. Thank you. And God bless.
See you next time.
All right. See ya.